Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Rene Reyna, head of Thematic and specialty product strategy at Invesco, to discuss insights into insurance companies and how they're weathering market challenges and a specialized approach to investing in them. Rene, it's great to see you as always. Welcome back to Trade Talks.
Hey, thank you, Jill. Glad to be here.
You got it. Insurance companies are currently underperforming the broader market. Are the recent extreme weather events to blame?
Yeah, so the insurance segment's interesting, I guess I just want to acknowledge today, I think, one, extreme climate events are clearly on investors' mind, especially if you're looking at insurance companies. And then, today just, the timing of today's call, but, a Hurricane Dahlia hitting Florida as a Category 3 storm, I think just reminds us at times just how, extreme weather has kind of been lately. But, going back to the other question, so insurance companies as a segment, investment segments, been interesting. If we look at results this year, last year, I think we got to take a step back. 2022 was a, pretty solid year for insurance companies. I think unpacking and understanding why, in a year where, the broad market or S&P was down about 20%, if we look at the KBW, Nasdaq, property and casualty insurance index, for example, you see a group of companies that are up 10%. So why is that? I think for insurance companies, you generally see some pricing power advantages that allow them to sort of weather the storm, if you will. So last year was a year where you continue to see premium or price increases, which helped insulate some of the inflationary costs from the claim side. So we've all experiencing inflation. I think last year was when we first started to see inflation sort of tick up and peak. So lumber costs were going up, auto claim costs were going up, and the premium side that insurance companies were able to pass on through customers helped offset some of those margins. So for investors last year who were looking for spaces that were a little insulated as it relates to the inflationary challenges, insurance companies was a good place to invest. We flash forward to this year in 2023, we've seen a little of those gains come off. And so what's been driving that, if we look at earnings calls recently, we see that basically the premium increases that insurance companies were passing on just wasn't enough to offset some of these inflationary costs around the claim side, one. And then two, just from a catastrophic claim perspective, we just saw claim a cost just increase beyond sort of what the expectations were. So that sort of hindered insurance companies so far this year. And is the primary reason why we're seeing some of this downdraft. I think the good news is, insurance companies generally are able to weather the storm through some of that pricing power, especially in a hard market like we see today.
So is now a good time to take a look at property and casualty insurance companies?
Yeah, so I guess we talk to clients today, we sort of look at this space. So if I take a step back broadly, financials are somewhat discounted relative to the broader market. So there's some interesting components there from an entry point. But I think it comes back to what insurance companies have and are able to do. So we've seen, about 22 consecutive quarters of premium increases from insurance companies. These premiums are up about 7 to 10% on a year-over-year basis. I think that's expected to go into 2024. So I think that's some positive backdrop for insurance companies. On the reinsurance side, you see those premiums up to 15, almost near 20%. And so that's clearly offsetting some of those inflationary costs. I think also from an inflation standpoint, hopefully we're at a point where rates will no longer go up. So may stay higher for longer, but in terms of additional increases, I think the backdrop there could be positive for insurance companies. And then if we just look at forecasts weather-wise for this year, generally speaking, it should be a more normalized environment from a weather perspective, hurricanes and the likes. Now, clearly, we can't predict, how extreme these hurricanes can be. So I think from a claims perspective, just keep an eye on that. But I think generally speaking, the ability to rise premium costs, I think stability in terms of these inflationary costs, I think are a little bit more manageable and hopefully will start reversing on the way down. And then again, I think the backdrop around just entry point and looking at some of these companies in this particular space, could be a good entry point into insurance companies today.
Rene, tell us about your specialized ETF that provides targeted pure play exposure to the insurance investment theme.
Yeah, so I think the good news is for investors who are interested in looking at insurance companies today versus selecting individual stocks, you can get convenient exposure with an ETF. And so we offer the Invesco KBW Property and Casualty ETF. What this ETF does is it tracks the KBW Nasdaq Property and Casualty Index. And so this is an index of 24 insurance pure plays, commercial lines, personal lines, insurance, reinsurance. So you're really getting pure access to this particular space. It's a passively managed ETF, but there is quarterly rebalancing, quarterly reconstitution. So just a great way to get exposure and access to the theme. Currently, the fund has about 153 million in assets under management. It's been around since 2010, so there's a track record there. And so just really a convenient way to get pure play access and get a ticker on that particular fund is KBWP.
All right, Rene, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.